Ladies and gentlemen, the next session is BOT's Monetary Policy to Accommodate the Growth by Dr. Virathai Santiprapop, Governor of the Bank of Thailand. Mr. Virathai is the 23rd Governor of the Bank of Thailand, and he's a macroeconomist, strategist, and financial professional with more than 20 years of experiences in economic policy design, commercial banking, and capital market. He began his career in 1994 as an economist at the International Monetary Fund in Washington, D.C., before serving as a co-director of the Policy Research Institute of the Thai Ministry of Finance during the 1997 Asian financial crisis. In 2014, Dr. Virathai was appointed to be a member of the Bank of Thailand's Board and Monetary Policy Committee. He has also been a member of State-Owned Enterprise Policy and Supervisory Committee and was an advisor of Thailand Development Research Institute, or TDRI. In private sector, Dr. Virathai was a senior executive of Siam Commercial Bank Public Company Limited and the Stock Exchange of Thailand. He held various positions at the boards of leading corporations, including Thanachart Capital Public Company Limited, Bangkok Dusit Medical Services Public Company Limited, Thai Airways International Public Company Limited, and Central Pattana Public Company Limited. Okay, and the Q&A session will be moderated by Mr. Warin Sachadel from TNN 24, Radio Thailand, and FM 101. Ladies and gentlemen, please join me in welcoming Dr. Virathai Santiprapop on the stage.
Ladies and gentlemen, a very, very good morning to you all. It is my pleasure to be addressing you this morning. I will take this opportunity to speak to you about Thailand's economic outlook and monetary policies at this important time. But before I move on, I would like to first thank the Stock Exchange of Thailand for hosting this event and all participants for your interest in the Thai economy and the Thai capital market. This is an important time not only for the global economy, but also for the Thai economy. After 5 years of subpar growth rates, Thailand has managed to restore economic growth to its potential. As the economy moves from a recovery phase towards an expansionary phase, the role of macroeconomic policies needs to evolve accordingly. What used to be a stimulative tool will eventually have to transition into a support on which the economy could grow on a sustainable basis. Furthermore, we need to step up structural reform policies to address long-term challenges. And I'm sure you have heard from the Deputy Prime Ministers and the previous 2 ministers about various structural reforms that the current administration is putting in place. Ladies and gentlemen, the turning point of macroeconomic policy stance is not a straightforward one. Imagine yourself on a road trip with a group of friends. You are driving, and one of your friends asks you, when will we make a turn? If you have a GPS navigator or open up Google Maps, you might be able to say with precision in 2.5 kilometers. When talking about a policy course, the answer might be in the next 2 or 3 quarters if things go according to plan. In real life, we policymakers do not have the luxury of having a GPS navigator, not to mention the fact that this said turn could be moved closer or further away without giving any warnings in this volatile world. What we do have, however, are indicators we observe from our surroundings and indicators of road conditions and possible storms ahead of us. Similarly, the Monetary Policy Committee considers a number of factors when formulating a policy decision, not only the current state of such factors, but also the long-term trends and expectations of risk scenarios going forward. For a small open economy in an increasingly volatile world like Thailand, Monetary Policy Committee's decisions will have to be data dependent. In my address to you this morning, I will share with you the factors that the Monetary Policy Committee considers when making policy decisions. Since the main objective of a flexible inflation targeting framework is to attain sustainable economic growth while preserving price and financial stability, I'm going to take inflation, growth, and financial stability each in turn. Ladies and gentlemen, the first factor that the Monetary Policy Committee takes into consideration is inflation. Since 2015, the Bank of Thailand has set a medium-term headline inflation target at 2.5%, with a band of 1 to 4%. After running below the target for the past 3 years, inflation is finally back within the target range, albeit around the lower end, with headline inflation this year and next forecasted at 1.1 and 1.2% respectively. Some of the factors that have contributed to low inflation are transient, including large fluctuations in oil and agricultural prices. Nonetheless, core inflation, which is designed to look past these short-term fluctuations, has also been low as well, averaging only about 0.7% year-to-date. For policymakers and economists, stubbornly low inflation against the backdrop of the improving economy is quite perplexing. While core inflation is expected to edge up further, given a build-up in demand pool inflationary pressures, many structural changes warrant monitoring, as they might contribute to lower levels of inflation than in the past. This is an ongoing area of research by central banks around the world, as low inflation is not Thailand's only problem, but seems to be shared by a number of countries. Many studies, including Bank of Thailand's own, find that there are several factors that would have impacts on long-term inflation dynamic. Aging population, which implies more saving, manufacturing automation that drives the cost of production down, and online platforms that take away pricing power of traditional merchants are some of the few issues that have contributed and will continue to contribute to the low inflation in the long run. For central banks, concerns over inflation deviations from target is not symmetric. We would be more concerned if there is any indication that inflation will cross the upper bound of the target range. As long as the economy continues to expand close to its potential, with no indications of deflation expectations, and low inflation can be attributed to structural factors, central banks need to strike an appropriate balance between trying to achieve the midpoint of the target range and other policy objectives. By relaxing monetary policy further, or maintaining extremely accommodative monetary policy stance to achieve the inflation target would risk unintended consequences of overstimulating the economy and excessive risk-taking behavior in the financial system. Having covered inflation, I will now turn to growth. In the first half of 2018, Thailand's GDP grew at 4.8%, the strongest two-quarter performance in 5 years. The solid growth number slightly beat our expectations back in June when we revised our 2018 GDP growth forecast from 4.1 to 4.4%. These latest information, along with other developments in the domestic and global economy, will be one of the key inputs for our next forecast round in September. While these numbers are in themselves impressive, what I think worth even more mentioning are the sources of growth. For the past few years, Thailand's growth was filled with imbalances, creating the so-called two-speed economy. On the high-speed track, exports of goods and services had been expanding robustly in tandem with improved external demand, consistently contributing over half of the GDP growth. The benefits from this growth, however, were felt mostly by those associated with the export sector, especially large exporters, leaving behind the low-speed domestic demand track. Private investments' gradual growth was also concentrated only within the export sector, while private consumption growth registered well below historical average, as strong export growth and pickup in manufacturing did not lead to higher employment and higher household incomes. Excess production capacity in certain manufacturing sectors and a movement towards automation in manufacturing processes were some of the reasons often cited for this disconnect. In addition, a high level of household debt constrained private consumption growth, as households had to use additional income to service their debt obligations rather than spending on goods and services. More recently, even though the imbalances still exist, we started to observe a change in this trend. We begin to see a more broad-based growth in exports, reaching beyond large exporters. We also begin to see steady growth in private consumption and private investment, making the strong growth performance in the first half of 2018 even more meaningful. Along with the recovery in private consumption and private investment was the pickup in loan growth, particularly consumers and SME loans. On the labor market front, we see continuous improvements in manufacturing employment, reversing a multi-year decline trend. These are encouraging signs that benefits from export growth has spilled over to other sectors. As we move into the second half of this year and the next, even more spillovers are expected from various public infrastructure projects that we have heard about earlier this morning from the previous speakers. Certainly, there are risks to this growth outlook, both external and domestic. Recent developments in the trade war between the United States and China, development of the financial conditions in vulnerable emerging market countries, as well as the recovery of tourism in the southern regions after the Phuket boat accident, are some of the major risks discussed by the Monetary Policy Committee. While monetary policy decisions will need to take these risks into account in supporting the economy towards a more robust growth, solving the two-speed economy requires solutions beyond the scope of monetary policies. Structural challenges that cause this two-speed economy require more precision tools like fiscal programs that could accurately target the specific sectors in need of support. Promoting education and skill reforms could help address the change in labor market landscapes that I mentioned earlier. As another example, creating an environment that stimulates innovation will be the key for boosting productivity and lifting Thailand onto a higher long-term growth path. The third factor that the Monetary Policy Committee considers when deliberating its policies is financial stability. The prolonged period of global low interest rate environment leads to another potential concern, search for yield that leads to underpricing of risks. It should be noted that search for yield is not uncommon and is all well and good if investors are well informed and manage their risks accordingly. However, we cannot deny that some investors are underpricing the associated risks. Debt accumulations among households, large expansions of foreign investment funds with high concentrations in certain emerging economies, saving cooperatives' growing asset base, maturing mismatch of corporate borrowers, and rapid growth of unrated bonds are some examples of the issues the Bank of Thailand has been monitoring over the years. More recently, we also noticed an upward trend in mortgage loans to home buyers who search for rental yield, driven partly by high loan-to-value ratio for mortgage loans offered by fierce competition in the financial sector. Furthermore, mortgage NPLs, especially among second and third home buyers, have continued to rise. On the regulatory side, the Bank of Thailand continues to monitor warning signs of financial stability risks and address them accordingly. For instance, last year, we tightened credit card regulations as well as uncollateralized personal loan limits to mitigate household debt problems. It is also our view that collaborations between various regulatory bodies and market participants are increasingly important for effective risk monitoring and assessment, together with appropriate measures to manage risks that might arise in the future. With regards to the extent to which financial stability conditions should be incorporated into monetary policy decisions, one prominent view is that financial stability should be addressed mainly by macro-prudential tools, and that, if effectively deployed, macro-prudential tools can free up monetary policies to focus solely on price and output stabilization objectives. While this might hold true in some advanced economies, operationalizing macro-prudential tools in practice, especially in emerging markets like Thailand, has proved challenging. Limited experiences and complex interactions among various policy tools make calibrating macro-prudential measures extremely difficult, not to mention the risk that these tools might inadvertently push some activities outside of the regulatory umbrella into shadow banking. My view, therefore, is that macro-prudential tools are complements rather than substitutes for the broader monetary policy stance. Ladies and gentlemen, the three factors I have mentioned, inflationary pressure, growth, and financial stability, are factors that the Monetary Policy Committee consistently looks at when deliberating monetary policy transitions under the flexible inflation targeting framework. But before I make my concluding remarks, I would also like to mention that when we are confident that economic growth is close to its potential and inflation will remain within our target range, the MPC can also take a longer view. And this is when policy space should be taken into consideration. Two considerations are at play. First, history has taught us that a period of prolonged economic expansion comes with asset price bubbles and market corrections and recessions. A gradual, anticipated movement in the policy rate reduce the risk and the size of such outcome. Second, through the most recent economic downturn, our policy rate has been lowered to 1.5%, a quarter percentage point above the historic low level of 1.25% implemented in 2009, immediately after the peak of the global financial crisis. This was done with the aim to stimulate economic recovery. We now have limited monetary policy space to act should unexpected adverse economic conditions emerge in the future. In very much the same way that our foreign reserves build up in times of capital inflows allows us room to conduct diverging monetary policies and smooth out sudden capital outflows, as we have seen during the past few months. Building up some policy space for the future should be a prudent consideration. Ladies and gentlemen, with the ample external buffers we have built up, Thailand so far has the autonomy to deliberate our own monetary policy. I have outlined for you the main factors that the MPC considers: inflation, growth, and financial stability. We expect this year's headline inflation to be in the target range, abide around the lower end. In the longer run, however, structural changes and their effects on inflation dynamics will need to be taken into consideration when deciding an appropriate monetary policy framework. Concerns over the economic recovery have lessened over the last few quarters, as the economy has made a clearer recovery with a more balanced growth. Nonetheless, certain risks to the growth outlook remains, and monetary policies still plays a role in supporting a more robust growth in domestic demand. In this light, most Monetary Policy Committee members in the last meeting viewed that current growth momentum still warranted monitoring, and monetary policies should continue to be accommodative for some time. However, we are mindful that ultra-accommodative monetary policy stance could lead to unintended consequences. The prolonged period of very low interest rates has a side effect that they could undermine long-term financial stability. Therefore, We have been monitoring developments of search for yield and underpricing of risk behaviors in various sectors. Let me emphasize once again that Monetary Policies Committee decisions are data dependent. Economic and financial developments, their trends and risk factors have been and will continue to be weighed carefully by the Monetary Policy Committee. I am certain that we will be able to navigate the Thai economy towards sustained growth in this increasingly volatile global landscape. Thank you very much for your attention.
Sawasdee krab. Thank you, Governor, for your very informative speech on how to maintain the sustainable growth for our Thai economy. You mentioned so yourself in the beginning of the speech about the escalating and seems to be never-ending trade war, tit for tat, China and the United States. How do you see this having an implications on the emerging markets, especially our economy, Thai economy?
Oh, thank you very much, Khun Warin. This will continue to be a major risk that we have to keep our eyes on very closely. I would say that the impact could come in various channels. The direct impact, we started to see some direct impact on our exports to the US economy. If you recall, the earliest phase of trade protectionism measures that came out were product specific, like solar cells, washing machines, certain types of washing machines. So lately, during the past few months, we started to see a drop in our exports of those products to the US economy. But they constitute a very small portions of our total exports. The direct effect, the direct channels for us might not be that alarming. But we have also need to look at the impact on the Chinese manufacturing exports. You might be aware that around half of Chinese manufacturing exports are re-exported of products that get exported to China within this Asian complex supply chains. And that hasn't been that visible yet. I think we keep monitoring for the next few months to see to which extent there's an indirect impact through China, through the supply chains that we have implications for Thai manufacturing producers. When we talk about trade protectionism, economic theory would also talk about trade diversion. It's not only the direct impact, but the trade diversion. There are certain goods that Chinese exporters used to export to the US, but now they might not be longer able to export to the US. We might benefit from that. Some of that trade flow might get diverted to countries like Thailand. But trade diversions can be positive and negative. Having said this, it's also very much related to the supply chain linkage within East Asia, and that is not clearly visible. Certain companies might be hit very hard if they have concentrated customers in China that happen to be a victim of this trade protectionism. So our estimate is that the impact so far has been small. The impact for third quarter started to emerge. The second half of the year started to emerge. If the situation gets escalated, the protectionism, the war gets escalated, the impact will be more robust next year. The other impact that is more of a concern is on investment, private investment. As we know, the world is hoping to get more private investment, and Thailand in particular. But this protectionism environment is not conducive for investment decisions. We have seen delays in investment decision, and that's another risk factor that we have to keep our eyes on.
How long do we monitor this? I mean, where do you see this escalating, this tension between the big economies in the world? Where is it heading? Will it ever end?
Well, I hope there is someone in the world who can answer that question. Some people might say that it's up to the midterm election, but but who knows? One has to remind ourselves that the damage has already been done, and we talk about trade protectionism, if you look at economic theory, we also talk about effective trade protectionism, right? When you impose tariff on raw materials, the like of aluminum and steel, that will have impact on industries that use such raw materials for production.
Exactly.
Like electrical appliances in the US. So there have been, or there might be lobbying for more protectionism on their products. So there's a change event that we also need to monitor, and political economy plays a big factor in this game.
Apart from trade and the policy on protectionism, there's also concerns in the US monetary policy, and we've been seeing outflows from the emerging markets. What happened in Turkey, Argentina. How immune are we to those kind of US monetary policy being tightened?
Our external position has been quite strong. And I think I would say among the strongest as compared to emerging market countries. We have depended very little on foreign financing. If you look at the size of our international reserves, it's more than ample. It's about 3.5 times of short-term external debts, and it's about 1.4 times of total external debts, private, public sector, long-term, short-term combined. And on top of that, we have large current account surplus. We have had a current account surplus in the range of about 10% of GDP during the past 2 years. This year, we expect to have current account surplus of about another $40 billion US. And that has provided us with good buffers, so that we have autonomy to deliberate our own monetary policies. Unlike our emerging market peers, certain emerging market peers that might have vulnerable external conditions, and they may have to respond to the tightening of the global financial conditions much sooner and much more immediate. So the need for us to increase policy rate, if you take into account the external pressure, is not imminent. It's unlike our emerging market peers, and we have autonomy to deliberate our own monetary policies to meet domestic, to answer the domestic needs of our economy.
Are we being too conservative with our international reserve at the Bank of Thailand?
What do you mean by being too conservative? When we talk about the macro perspective in general, you have to look through the horizons. We knew that when the advanced countries were pumping in liquidity into the global financial system, and that caused a lot of inflows into emerging markets. One day in the future, everyone knows that normalizations would take place, and there would be a reversals of capital flows. And as I have mentioned earlier, during the past 3 months have demonstrated that countries that have good enough buffers can be insulated from the volatility and the increasing volatility that the world has experienced. And countries that do not have strong enough buffers, and foreign international reserve is one of the buffers that countries should have. They're in a much more vulnerable positions.
So once again, what makes us different from other emerging markets, apart from we've been dealing quite well with our reserve as a buffer?
Well, current account surplus, low domestic financing, low and external financing dependence. I'll give you an example of an indicator. When you look at non-resident holdings of Thai bonds, or this state, public, or the public bonds, central government bonds, state enterprise bonds, and Bank of Thailand bonds. Non-residents account for only about 10% of total bond outstanding. If you look at other emerging markets in the region, that ratio could be as high as 40%. So they're much more vulnerable to the increase in global interest rates than we do. And we still have ample domestic liquidity. The banks, Thai banks, also depend a lot on domestic liquidity, on their deposit base for their lending. So whatever happens in the global financial conditions does not translate it immediately, or doesn't pose any threat to domestic liquidity shortage, like in vulnerable emerging markets countries. And I should say that the strength of Thai banks is also another good buffer that we have. If you look at the capital adequacy, the risk management, if you compare the situation now to the situation 20 years ago during the Asian financial crisis, the risk management framework has changed drastically.
U.S. interest rates is on the hike, the policy rates. Are we under pressure to follow suit?
Well, as I said, so far we have autonomy to deliberate our own monetary policies. But obviously, the interest rate has been very low globally for some time, and that has also posed challenges on financial stability and unintended consequences that I mentioned in my speech. And that's a factor that the Bank of Thailand has considered regularly to ensure that by maintaining ultra low interest rate for a long time, we don't create pockets of fragilities that could pose financial stability risks in the future.
So do we see any rate hikes in our economy?
It's up to the Monetary Policy Committee to decide, and I'm only.
And if that happens, what would be the implication on the sectors?
If there is a rate hike, if you look at the monetary policy statement, the Monetary Policy Committee sees clearly that there is a role for continued accommodative monetary policies. And we look at the global, even the Fed dot plot. We do not expect interest rate once normalized to go back to the pre-crisis level. Interest rates globally will be lower than the pre-crisis level, even though after the series of hikes along the normalization path. I think that's the belief that most macroeconomists have.
Moving now to all the initiatives we see from the Bank of Thailand in terms of the fintechs and the standardized QR code. What's the vision for the fintech landscape coming from the Bank of Thailand?
Well, we also need to reform our financial landscape, and fortunately we have financial technology available, much more powerful financial technology at a much more affordable prices. So the Bank of Thailand, together with the Thai Bankers Associations and also the non-bank financial service providers, we started developing electronic payment systems and ecosystems to support electronic payments. Because when we look at the usage of electronic payments in Thailand has been quite low as compared to neighboring countries, and Thailand has pretty much been cash-based economy. To improve productivity in the financial systems and also improve productivity of the economy as a whole, we started off with promoting electronic payments. You may have heard the PromptPay platform that we launched about slightly over a year ago, and it was the first large-scale faster pay system ever launched in Southeast Asia. And within a period of about a year, now we have about 42 million subscribers, and people can use their mobile phone or citizen ID number as proxies for electronic fund transfers, and the fee has been coming down substantially. And this is an open platform. The banks have invested in the platform, but the platform is also open to non-bank service providers. And this led to complete eliminations of electronic fund transfer fees by the banks in March, when all the banks decided to announce. I think that's a big change. It helped improve productivity of electronic transfer. It also opened up opportunities for small merchants, for individuals to leverage on this efficient and very cost-effective fund transfer platform to build up the additional businesses. This is one of many things that we have adopted. We believe in creating an open platform, a platform that is interoperable, so that we can ensure that innovations will continue to occur. Competitions will continue to be dynamics. When it's a small players with innovative idea, innovative technologies would like to come into the Thai market, having an open platforms will make it much easier for them to offer their services. I'll give you the standardized QR codes. QR code is not something new. I mean, in big countries, in the regions, they have used QR codes for quite some time, but they're not standard. And each platform has its own QR code. It's not only inconvenience for the merchants, but the big giants, they have locked in very large market shares. I think you look in China, WeChat Pay and Alipay, each of them have about 46, 47% market share. Very difficult for new players to penetrate that market. When we saw this and we want to launch this in Thailand, we said we better have a standardized QR code and make it an open standard so anyone could come in with this standard. And on top of that, customer payments information can be consolidated within one platform. And this is something that we very much hope that Thailand one day we can transform lending to SME from collateral-based lending to information-based lending. And without having electronic payment information available on a consolidated platform, it will be very difficult to make such a move.
Will fintech opens door to competition from overseas, and how do you see this developing in our country? Because we are still in the financial system, which is pretty much an oligarch controlled by only few players in the industry. Will fintech change this?
No, definitely, but that's not very true. You see, if you look back 4 or 5 years ago, I would categorize it that you see a lot more players coming into the market, the like of e-wallet companies, non-banks, service providers, and it's also our policy is to liberalize that sector. If you look at the new Payment System Act that we introduced, it became effective last April, and a lot of licensing regimes in there also move along the liberalization path that we have envisaged in our payment system development. We have reduced, for instance, the amount of paid-up capital required to offer the like of e-wallet services. The landscape will continue to be more competitive with the guiding principles of having an open platform, interoperable platforms, and this is also in line with our capital account liberalization regimes. We would like to see more players coming to the market, particularly to serve the small and medium enterprises.
Technology disruption, since we talk about fintech, and this is Thailand 4.0 as well. So how do you see the technology disruption affecting the overall economy, if not the financial industry?
Well, technology presents challenges and opportunities. If any firms does not adopt new technology, there's a risk of being disrupted. The business model can be easily disrupted. We have already seen, starting from those industries that serve as middlemen, basically. Technology will allow middlemen to be bypassed easily. And that is not only in the financial sector, it's also true in other sectors. So it's very important that businesses adapt their business model accordingly, adopt new technology. The other aspect that we need to be embedded in the core activities of the businesses is data, the ability to collect customer information at a micro level, transactional data, and be able to use that data for risk management purpose, for business planning. Data analytic capability will be an important aspect of any business, including the Bank of Thailand. We have to set up a big data analytic team, aggressively recruit people who can do data analytics, so that we can be sure that whatever policies that we prescribe is data dependent, is evidence based.
Yep. Yeah, that's the word we hear many times already in your speech as well. Data dependent. That's the way for the MPC to actually come up with the policies, being data dependent. So, and last but not least, we're here to actually convince investors to keep investing in Thailand. So, what would be your key message to all our investors waiting for a sales pitch from the governor of the Bank of Thailand?
It's not the duty of the governor of a central bank. I think you have heard a lot of exciting stories from the previous speakers about the reform that is being implemented in Thailand. For my part, I can add that I believe that Thailand has a strong macroeconomic fundamentals and also strong enough buffers to be able to withstand the global volatility. And we look at the normalization path, look at the history of normalizations during the past 2-3 decades. We often see a lot of volatility in capital markets during the normalization path. And we started to see that increasing even though Bank of Japan has not started normalized yet. European Central Bank has not started to normalize yet. But with all the buffers that we have built, Thailand should be able to navigate through all this volatility. Thank you.
And Donald Trump just tweets. He concurs. Thailand looks great. Thank you so much, Governor. Thank you. ขอบคุณมากครับผม ขอบคุณมากครับ